Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Tuesday everybody. As China has been struggling with economic slowdown and issues transitioning from its investment-driven growth model to a more consumption-led growth model over these last several years, there's been a growing number of voices comparing today's China with Japan in the late 1980s, suggesting that the country faces its own coming lost decades of stagnation. Quote, "A decade ago, when a few of us were warning of the astonishing similarities between China then and Japan in the 1980s and predicting that China would suffer from a long Japanese-style adjustment, most analysts were bewildered by the comparison. Today, very few analysts still think the comparison unlikely." End quote. Today we will do something a little different. We're going to use the entire video to unpack this very question. Joanna Chua, chief China economist at Citigroup, recently observed, quote, "China's policy responses so far this year could put it on track for Japanification." End quote. This year too, Richard Koo, an economist at the research arm of Japanese investment bank Nomura Securities, who famously coined the term balance sheet recession, used the term to describe China's current state of affairs. However, economists from Bank of America recently pushed back, stating, quote, "We believe worries on China being trapped in a balance sheet recession are overdone." End quote. We will return to Koo shortly. In an October note called "Is China Facing Japanification?", Goldman Sachs Research China expressed, quote, "While deteriorating demographics, a debt overhang, and an asset bubble burst were all important ingredients in Japan's malaise at the turn of the century, a key contributor to its Japanification was a fundamental change in longer-term growth expectations. Growth expectations in China, which is also coping with worsening demographics, a debt overhang, and a deflating property market, are showing signs of a downward drift. The key to avoid such a negative feedback loop is to cut off the continued deterioration in longer-term growth expectations." End quote. James McIntosh, a senior markets columnist with the Wall Street Journal, argued earlier this year that investors in China have had a lost decade already, writing, quote, "Domestic share prices are lower than they were in 2007, and earnings per share are the same as in 2013. End quote. Recently, too, Stella Yifanxie, a Hong Kong-based reporter covering the Chinese economy, published a piece with the same outlet, the Wall Street Journal, called "Is China's Economic Predicament as Bad as Japan's? It could be worse. From demographics to decoupling, China faces challenges Japan didn't after its 1980s bubble." In the piece, Xie argues that many economists say China looks very similar to Japan. Quote, "The reality, in many ways, its problems are more intractable than Japan's. China's public debt levels are higher by some measures than Japan's were, and its demographics are worse. The geopolitical tensions that China is dealing with go far beyond the trade frictions Japan once faced with the US. Another headwind, China's government, which has been cracking down on the private sector in recent years, seems ideologically less inclined than Tokyo was then to support growth." End quote. Xie does admit that by some measures, though, China's asset bubbles aren't as big. Morgan Stanley estimates that China's ratio of property value to gross domestic product peaked at 260% in 2020. In Japan, land values as a percentage of GDP reached 560% of GDP in 1990, before falling back to 394% by 1994. The Tokyo Stock Exchange's market capitalization rose to 142% of GDP in 1989. China's equity markets, on the other hand, hit a record peak of 80% of GDP in 2021 and now sit at 67% of GDP. Though some might argue that if China's GDP is overinflated, then these rates would be different. Xie also points out that China has a lower urbanization rate than Japan in the late 80s and tighter control over its capital markets and currency. In a recent piece called "China's Leaders Speed Towards Japanification," UK-based Reuters confidently expressed, quote, "The real estate collapse, instigated by Beijing's belated attempts to deflate the bubble, has brought China closer to the edge. After 1990, Japan's banking system was slow to resolve its bad debts. This week, Beijing ordered state-owned banks to roll over local government debt with longer terms at lower interest rates. Japan's share of global GDP went from 17% in 1990 to 7% over the following couple of decades. On its current course, China's economy is heading in the same direction. End quote. This is quite the prediction. Prominent voices have for some time made compelling arguments for and against this comparison, and while of course the systems and situations between Japan then and China today are vastly different in many ways, the consensus now appears to be that yes, Beijing should at the very least be vigilant that it doesn't follow the same path and should learn from Tokyo's mistakes. This conversation was happening privately in China, but that private conversation is becoming much more public. I hope you're enjoying today's episode. If you're getting some value from this episode, I only have one ask. That is to like and subscribe. And if you really want to go the extra mile, sharing is also a big help. This is the primary way in which this channel grows. The main way it is shown to new people is if the algorithm is happy, and that means likes and subscribes. For anyone who wants to help keep the channel financially sustainable, which allows me to continue doing this every day, open and free for all, Patreon and Buy Me a Coffee links are in the description below. My commitment has been a channel open to all that is reliant primarily on subscriber support rather than corporate sponsorship, and with your assistance, I know I can keep it that way. Thank you so much, everybody, for the ongoing support. Let's continue. This week, widely read Chinese financial media outlet Caixin published a special cover story called "China May Find Cure for Stagflation by Studying Japan's Experience." Before we even examine the points made in the piece, we should note that the title itself is telling. A prominent Chinese financial publication is admitting that China is facing stagflation, an incredible statement to make considering the current political climate around the economy. The piece argues that amid strong wage growth and rising prices, Japan is finally emerging from the quagmire of almost 3 decades of deflation, as China faces similar challenges that its neighbor did 30 years ago. Japan's experience may offer lessons to Chinese policymakers about how to battle prolonged stagnation. Japan, the piece continues, the world's 3rd largest economy, has suffered from sluggish economic growth and recession since the early 1990s, yet it has maintained its status as a highly developed economy, avoiding the middle-income trap. The country has maintained fiscal sustainability, social stability, and welfare levels, all while dealing with an aging population. Where potential lessons may lie are in the answer to the question of whether Japan could have avoided years of zero growth had it pursued different monetary policies or adjusted its policies sooner. Quote, "China, the world's 2nd largest economy, is facing the triple challenge of mounting debt, an aging workforce, and deflation," according to a report by Morgan Stanley released in August, raising concerns that the country is headed for a fate similar to Japan in the 1990s. Analysts at the US Investment Bank say China can steer clear of such a debt deflation spiral if policymakers act quickly and decisively. End quote. To do so, the Caixin authors argue, quote, "China must resist the head-in-the-sand ostrich mentality that prevented Japan from identifying its crisis sooner, and avoid the hesitation and repeated wavering in easing monetary policy. Japan was too slow in responding to its plunge into stagflation." End quote. This article has caused a bit of a stir this week among China finance analysts. Quote, "I fully agree that Chinese policymakers must ground their own responses in a thorough understanding of what went wrong in Japan. For me, the question is why, for all the determination to do so since the Maekawa report of 1986 hasn't been so brutally difficult for Japan to shift its economy away from manufacturing and investment and towards a greater reliance on domestic consumption. For all the promises since Wen Jiabao's 2007 speech, China also hasn't been able to manage the shift. Shifting from investment to consumption seems like such an easy thing to propose, but has always proven extremely hard. Beijing has to figure out why. I would suggest it is because this shift requires a potentially disruptive transformation of the economy and political system, with political, business and financial institutions built around 3 to 4 decades of transfers in one direction respond to a reverse of those transfers. But what Japan shows is that once most of the investment needs of the economy have been met, the longer it takes to restructure the sources of demand that drive economic activity, the longer will be the period of economic stagnation. End quote. Let's return once again to Richard Koo, the Nomura Securities economist who coined the term balance sheet recession. We will end today's video by examining selected excerpts from an interview he gave this year on Bloomberg's Odd Lots podcast, which we are now quoting directly. A lot of Chinese journalists and economists have been contacting me on this issue. Are we going to be Japan soon? Or are we already on that path? And my answer to that is, well, there are a lot of similarities between what happened to Japan 30 years ago and what's happening to China today. But there are also important differences. And what the Chinese economists are worried about is that China may be falling into what I call balance sheet recession. And balance sheet recession is triggered by this whole nation that people feel uncomfortable with their balance sheets. Suppose their debt is too large relative to their assets, and that typically happens after bursting of a bubble. If the bubble is financed with debt and asset prices collapse, but the liabilities remain, people realize that their balance sheets are underwater. And if it's the balance sheet underwater, you have to fix it. Well, how do you fix it? You pay down debt. Well, that's the right thing to do at the individual level, but when everybody does it at the same time, we get into the fallacy of composition problems. In that, in a national economy, if someone is saving money or paying down debt, you need someone else to borrow and spend the money to keep the economy going. And in the usual economy, you get too few borrowers, you bring interest rates down, too many borrowers, you push interest rates higher. And then that's how you keep the economies going. But when the big bubble bursts and asset prices collapse, everyone will be paying down debt. No one will be borrowing money, even at zero interest rates, because if your balance is underwater, you're not going to borrow money, even if interest rates come down to zero. And that's the prospect that Chinese are worried about. And China has this huge bubble, especially in residential real estate. And the amount of price increase that China observed on the residential real estate is almost the same as what happened to Japan 30 years ago in Tokyo and Osaka. And so when the real estate bubble started collapsing last year, all these Chinese economists began to worry about a Japan-like situation where so many people are paying down debt all at the same time, and the economy could then fall into a deflationary spiral. I think that is actually already happening in China. A lot of people are saying very few people are borrowing, so many people are paying down debt, even with these low interest rates. And that's a very bad sign macroeconomically. Individually, they might be doing the right things, but collectively, they are killing the economy. But there's also a big difference between the Chinese situation and the Japanese one, and that is that Chinese are already very well aware of this risk. And 30 years ago when this thing happened to Japan, no one in Japan, including myself, had any idea about this balance sheet recession because it was not taught in economic textbooks. I mean, certainly not when I was going through. Whereas in the Chinese case, they are fully aware of this recession, and that's why they've been calling me very frequently these days. So my guess is that the Chinese government will put in the fiscal stimulus, which they're actually quite good at, and that will keep the recession from turning into a depression or something. So that's the key difference between the Japanese situation 30 years ago and what the Chinese may be facing with today. That is, they already know the disease they're dealing with. My guess is that they'll go straight into the fiscal stimulus to keep the economy from losing its power. As we move into 2024, this may well be the tightrope in which many policymakers will have to walk, and we will follow that precarious walk as it unfolds next year. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Tuesday, and I will see you all tomorrow.